Many of you probably don't know this, but ICT created a trading model specifically for his daughter. Yes, we've heard about Caleb's model, we've heard about all of ICT's different models, but which model did he develop for his daughter? Now, the reason why he developed this model was actually because he wanted to make it very simple for her to keep her engaged in trading. So if you're looking for a super simple, straightforward strategy that you can consistently repeat over time to pass your first combine, prop firm, or build your accounts and equity in it, this is the right video for you. Let's get straight into it. Now, this is going to be very simple. I'm going to explain this strategy to you literally in 4 steps. So I want you to stick around for all 4 steps because the 4th one is actually where I'm going to show you the exact trade entry. But there are a couple important things that you need to know first before you ever think about entering a trade. And this is super important because I like to say this analogy a lot. Not every strawberry in a strawberry field is perfect for picking. Just because you see a strawberry that may look juicy and red on the outside doesn't necessarily mean that it has all the qualities, right, to be a good strawberry for you to actually consume. And that's the same thing with trading. Because you may see an entry model that fits that pattern you're looking for, it doesn't necessarily mean that you're in the right conditions, the right time of day, or the right area of the chart to be able to execute. So let's go over these 4 steps, and then we'll talk about entry model, and then I'll give you guys a live example of a trade that I took using this particular strategy. The first step in the 4 steps that you're going to need to know: 1, it's going to be bias; 2, time of day; 3, intermediate time frame order flow; and lastly, your entry model. Let's start off with bias. Now, what does bias really mean? Bias is a inclination or the ability to understand based off a analysis that you've conducted on the charts that you have a reasonable expectation prices to gravitate towards a certain part or towards a certain level. So what does that really mean? To break that down even further, typically, very simply, it just means that you have a feeling on a higher time frame chart the price is likely to gravitate towards somewhere. And so how can you develop a bias? Really, that is going to stem from looking at higher time frames, the daily, 4-hour, and the 1-hour. Okay, so you're going to need to be able to look at the daily starting off first and initially get a sense of where you think price is likely to go. And price is likely to go towards either 2 levels, right? Especially if you're a beginner, these are the 2 things that you should keep in mind: pockets of liquidity, right? So relative equal highs, relative equal lows, or inefficiencies. And so you see on this chart here, there's like relative equal highs here. Okay, so after we come down here lower, right, and we take out this candle's low here, and we start to create a daily bullish order block here, we now can see that these, relative equal highs are going to be the next good draw on liquidity, right? Or let's say, for example, over here on the chart, where price has now come down here, taking out these relative equal lows already, right? Where's price likely to go now? Well, there's an inefficiency right here, a fair value gap. Okay, so price is likely to draw there. So, depending on where you are in the chart, let's say you're up here and you see these relative equal lows here, right? And we look like we're going to be bearish, then this is going to be your next draw on liquidity. Your bias is short, right? But let's say you've taken out these relative equal lows, right? And you start to come back into the range, right? And you have an inefficiency above here, then your bias is going to be longs because you want to see a retracement back into an inefficiency. And so you need to start from the daily time frame down to the 4-hour, down to the 1-hour, okay? And analyze and recognize what is going to be my draw. Where do I believe price is going to go, okay? Now, the next thing that you need to understand is time of day, all right? Now, I have separate videos on this, and I'll tag them in the chat. I need to make a different series of videos on this because actually time of day can be very, very complicated. But there are certain pockets of the day that are actually best and most ripe for price to gravitate towards a certain level, okay? And so, for example, 9:30 open, you typically have your Judah swing, okay? And then at 10 a.m., you likely have the AM trend, which means that we're likely to be making a series of higher highs or higher lows going towards our draw on liquidity, or a series of lower lows and lower highs going towards our draw on liquidity if it's a short day. And then around 11:30, anytime between 11:30 and 1 o'clock, you can get a run against the daily range, okay? So if you have been seeing price going up all day and it's now kicking off 11:30 and we're starting to pull back, right, then it's probably not a good idea for you to continue to long. It's probably smart for you to wait all the way for price to retrace. Or if you are a counter trend trader, then you can take a short around that time. If price has been going up all morning and you're looking for an opportunity to short, okay, then 11:30 is probably the best time to start looking at that, right? If it doesn't happen at 11:30, it's likely to happen at 12. If it doesn't happen at 12, it's likely to happen sometime between 12:30 and then before 1 o'clock. All right. And then 1 to 1:30, I like to call it like the afternoon opening range, right? That's a time where you are likely to have a very similar move to around 9:30, where you can have a Judas swing, right? Maybe taking out the lunch low before we continue to go higher, assuming it's been like a bullish day, right? So 1:30 is likely to be a Judas swing against what you think the PM trend is going to be. All right. And then after 1:30 to about 4 o'clock, that is now the PM session, where price is likely to either continue AM's move, or if we've reached our final targets for the day and there's inefficiencies lower, then price can pull back lower. So there are certain things that happen at certain times of day, and you need to make sure that when you're entering your trade, that it is going to be in line with what happens at that time of day. And you know what? I will create a separate video on that, because I believe that can be a little bit more complicated than usual. But I think the number one takeaway from this is that you want to be trading anytime between ideally 9:30 to 4 o'clock in the afternoon. All right. And I would avoid 12 to 1 o'clock lunch session, especially if you are not experienced. And to take it even further, if you want to be more cautious, I wouldn't really take any trades after 11:30. And then if you're going to wait until 1:30 to get into your next trade. So pretty much this strategy will be best, okay, for people who are beginners, anytime between really around 9:30 to 11 o'clock, and then 1:30 to 4 o'clock. All right. So that's the time of day that you need to know. Now, the next thing that we want to talk about is intermediate time frame order flow. Okay. Now, the daily bias is more that higher time frame, daily to 4 hour, 1 hour, right? Which it tells you that, over time, this is where I'm likely to draw to. But the intermediate time frame analysis really tells you how you're going to get there. Let's say, for example, on the daily or the 4 hour, 1 hour, right? You're expecting price to draw towards relatively equal lows. You're expecting it to draw towards relatively equal highs. But just because we have that draw, we need to actually confirm that price is ready to go there, right? That's going to be dictated by the time of day, but also by what you're seeing on the intermediate term time frame chart. So that could be the 15-minute, that could be the 1 hour, that could be the 5-minute even, right? And you want to see price starting to go in your favor, right? You want to see a break of market structure on the 15-minute, you want to see a break of market structure on the 5-minute, or a bearish order block forming on those time frames, or you want to see a rejection candle. And then you'll know that price is ready to get there. If the 15-minute is still bullish, but your daily is, you want to see the daily chart going lower, but your 15-minute is still bullish, then it may not be time for price to get to where you want it to go yet. And so you may need to wait until you see some more confirmation on that 15-minute time frame. Okay. And then lastly here, then you want to get into your entry model. And that is what I'll talk to you guys about. The entry model that ICT chose for his daughter. Okay. And a lot of you may be very familiar with it. It is called the 22 model. Okay. And, some people, they think they know this strategy, but if you don't apply the 3 things that I just said before this, then it absolutely means nothing. There is no point in taking that 22 model. That's why a lot of people do not succeed with it. But if you get it right, it can be one of the most profitable trading strategies, the easiest ones to see. There's not that much complicated about it. Let's start from here. If you look at the brush, right? 22 model is, let's say you have a series of lows, right? Lower lows, lower highs, lower lows, lower highs. Okay. Then you have final purge liquidity below this recent low. Okay. And then you have a break of market structure above this candle's high. And you need to have a fair value gap. Price returns back to that fair value gap and then continues to go away. All right. And it gets even better. Let's say if there's another low over here that price, let's say, took out over there, external range liquidity. And then that is now giving you double confirmation that we are likely to probably come and take out these relative equal highs above here. Now, we've heard about the 4 steps. I think it's very straightforward. Let's get into an example. Now, let's go through a very simple example of a 22 model trade that I took on Monday, April 14th of 2025. I believe it's very textbook. Now, you always want to start off with the higher time frame. Like we said, develop what you think your bias is going to be. Now, at this point, this part of the daily chart is a little bit wonky, right? Like we've already made such a really, really large drop. and we retrace back into a lot of these inefficiencies over here and stop at this other daily bearish order block. And now we're kind of just in a range, right? We are inside of the daily candles high and daily candles low here. Okay, so I'm expecting a lot of consolidation over the next couple of days because this candle did not expand after the first candle, right? This is a volatility filter. This is a pro tip for you guys as well. If you see the day, like if you see an inside day candle, right, daily candle that's an inside day, it didn't take out the previous day's high or low, then if the next candle does not take out that entire range, right, if the next candle doesn't do that, it's like it's to consolidate for a decent while, right, for at least another 2 to 3 days. And that's actually what happened this week. If you go back and study in your charts, look at it on April 14th, 2025, go back, you'll see exactly what I'm talking about. Notice how we didn't escape this range until the next week, right? So anyway, when you notice that the daily chart is not really giving you a lot of bias, like you can't tell what price is going to do, then that means you need to go on lower time frames, right? So let's go on the 4 hour to really establish our bias. Now, going into the AM session, you can see that we gapped higher. We had a new day opening gap here, right? So this is what we call an inefficiency, right? So this is an example of where you're drawing liquidity, where your bias is based off inefficiency, not necessarily relative equal highs or lows. And so how do I know that price is likely to draw there? Well, if we look further, you can see very shallowly, this candle's high took out Asian high, right, from Sunday Asian high. This candle took it out at 6 a.m. Okay, and so once it wicked it and came back into the range, not closing through it, but came deeply into the range, my next opinion is that, and what I would like to see next is that we're just rejecting and purging liquidity here to run lower and come back down into this liquidity void right here, right, which is really an inefficiency. And so we can keep that on our chart. Let's say, call this like a green box right here. Okay, you know what? Actually, let me make that really busy and green. Okay, so that will be our draw on liquidity. So now what we need to wait for is time of day and also intermediate term time frame order flow to go in our favor. Now we can cycle down to the 1 hour. Just make sure that what we're seeing here, right? You can see that the intermediate term time frame, right, which is basically just the time frames that are in between your entry time frame and where you're developing your initial bias, right? So we developed our bias on the 4 hour. I want to see the 1 hour and the 15 minute and the 5 minute kind of go in line with that. So you can see that the 1 hour also purchased high, created a 1 hour bearish order block right here. Okay, and then made a propellant block here going into the AM session, right? This is 11 a.m. candle right here, and you can see that this liquidity void is even a little bit more pronounced on the 1 hour. So you can even make it like that. Make this a 1 hour busy. It's larger, so I would like to see that whole range filled. It's also a liquidity void, right? It's like there's absolutely no trading here. It's absence of trading. It's incredibly inefficient, and I don't want to see price continue to go away with it if I'm truly bearish without filling that entire range. And now you can see on the 15 minute, especially, which is going to be your second most important time frame beyond where you initially formed your bias, because 15 minute is just a really, really great time frame to just make sure that you're on side in the market. You really don't want to be trading against a 15 minute time frame, especially on the 1 minute or the 5 minute. And you can see that candle purchase high, broke market structure below this candle's low. And pause the video. What do you see right here? There's something that is sticking out here that we've talked about. What do you see? Now, you're right if you guessed it, all right? ICT's daughter's trading model is right here in front of your face. So you don't even need to wait until you get to the 1 minute, right? You can see it forming here, right? High, higher high. And like we talked about earlier in the video, it's even better because it took that another external range high, right? And then broke market structure, right? And we have a bias, and the 1 hour told us that we're ready to start going, okay? And, right, it's the right time of day, okay? We're heading into the 9:30 open. We break market structure, we return back to this inefficiency, and where do we go? Lower. So where would your entry be? At this candle's high. Stop loss can be above here. And then your take profit is at the low of this liquidity void because you want to see that all filled in. Okay, so what RR would that be? This is an example of a trade you could take on the 15 minute. There's actually another one we took on the 1 minute. It's one I actually took. I got a better RR, but you could still have gotten a nice one here with a 1.8. Okay, now let's keep this 15 minute to be here, because another thing that I want to show you is that time frames are fractal, right? Which means that the same trade you can take on a 15 minute, you can get in on the 1 minute because price is still going to go to the same place. Price is still going to drop here, so you can get a better R to R, maybe if you wait until price has a 22 model that forms on the 1 minute in an area where you are liking to see, where you want to see price reject from, which is this fair value gap. And so let's cycle down. We can look at the 5 minute real quick if you want, but at this point, not super important. I know that I'm on side, so now I'm just going to cycle to the 1 minute. Okay. So we have our bias at our intermediate time frame order flow, and we're in the right time of day. It's post 9:30, right? And so what we want to see is for price to create an opportunity that is very obvious to us, right? You can see we come down here lower, we enter back at this 15-minute fair value gap. There's nothing super clean in here, so I didn't enter. Yes, I could have taken it on the 15-minute, but I wanted a little bit of better R2R, so I was waiting for something on the 1 minute to form. Okay, so we got a lot of consolidation here. And then what happens here? Where can you see the 22 model? Pause the video for a second. All right, now you're right if you said it happened in between this time frame right here. All right, from 10:42 to 11 o'clock. Now, one thing that you can actually see here is, notice what time this is forming, right? This is actually forming inside of a macro, right? So what is a macro? A macro is a specific time of day, right, where price is likely to, purge liquidity and, have a nice run, right? And so it can be one of the times where it's most profitable for you to enter a trade. So we can just call this the 10:50 to 11:10 macro. Okay, and this will typically happen. All right. This happens basically, there's several macros throughout the day. They happen at the last 10 minutes and the first 10 minutes of every hour. So if you go back and you backtest these 22 models, you'll notice a lot of them are forming in this time frame. Why? Because like I said, there's usually a run against liquidity, right? And then a change of direction of the market, or purge of market structure, or there's like a continuation, but there's usually a solid move happening around these times of day. All right, 10:50 to 11:10, especially another tip for you is that 10:50 to 11:10 is a really good time for price to move when there's been consolidation in the AM trend, which you can see there's a lot of consolidation here, okay? And so 10:50 to 11:10, if there's been a consolidating AM trend and we still have somewhere to go, this is a really good time for price to enter. And so, or for price to make a move. So price purges this candle's high. It also purges this external range high over here as well on the 1 minute, breaks market structure below this candle's low, right here on this candle, and what? There's a fair value gap. So what do? You enter in the fair value gap, the easiest low-hanging fruit there. If you're a beginner, right, you want to keep your stop loss above here. You could probably trim this a little bit, right, if you're a little bit more experienced, and you can hold it, right, above this candle's breaker, right, above this breaker, this series of down close candles, right, or above the last FEG's candles high. You can keep it there, but just for starters, you want to keep it at the ultimate high here. If you are a beginner, you can still get a really good R2R here, right? This is like a 1 to 6. So you enter here, and you can see price eventually breaks away and hits your take profit. All right. And so hopefully this video was helpful, right? We've learned all the 4 steps that it takes to take ICT Zotter's trading model. If you liked what you heard, press that like button, make sure you subscribe, press the notification bell, and join that free Discord below where you can actually ask me live questions. I'll be doing live streaming soon. And you'll have a ton more content in there for you guys to see. Anyway, until next time, guys, peace and love.